Today, in light of the recent volatility in markets, I wanted to talk about something super important that I think is so often misunderstood and mismanaged, even by many professionals in our industry. And this is the perception that there's a need for short-term government bonds or short-term U.S. Treasuries, which are the U.S. version of their bonds, versus, say, a longer-term bond. And what that means is that obviously a short-term bond is going to be anywhere, let's say 1 to 5 years, whereas a long-term bond, and not necessarily by definition, but it's going to be 20 to 30 years. So what is the advantage? So the advantage is that a short-term bond is going to mature quicker, it's going to be less volatile, or it's going to be less sensitive to interest rate moves, and when compared to long-term bonds. So now, the biggest thing is, why would we ever want to own this? So let's take into consideration just a standard market correction that looks like this. Ideally, what's going to happen, if this is the market, this is the stock market that you're going to notice, what you're going to see is if you have the bonds, they're probably going to look like this. And what that means is that they're non-correlated. Again, in a previous video, we talked about non-correlated assets. Whereas a short-term bond is probably going to look like this. Now the difference is that when you get this sharp decrease in the stock market or prices for equity indexes globally, what you want to make sure is that you have the proper insurance or the proper protection, which is the reason why you would want to own bonds in the first place, to cover that. And so as you can see, that is more attributed to a longer term bond because the sensitivity to that, because it's a 30-year bond, is going to be much higher than that if it was a short-term bond. Now, the downside is that when you run into positive markets, you're actually going to see that negative increase. But so what I want to consider is that and this is obviously not to scale, but if this is market performance over time without any type of volatility, and then this is, say, what the equity markets will do, and obviously it's exaggerated, what you're going to find is that long-term bonds are going to do this. Not exact, it's not perfect, but over time it's going to look like that. The advantage is that every time that you get to a peak and a valley, that's an opportunity where you get to rebalance and actually sell back down to your original asset allocation and buy the depleted asset class afterwards. So what's unique is you're going to have all of these opportunities over time to rebalance and capture upside and avoid downside as we move through markets. The difference is that if you had a short-term bond, it would kind of look like this. And that's not going to do anything other than just provide cash-like returns or a little greater than cash-like returns. So once again, we'll talk more about these details in future videos, but this is something important to highlight because too often as we run into more and more volatility, as we get deeper and deeper into this later in this market cycle, you want to make sure that you're owning the right assets that are going to protect your portfolio. I always laugh, like you want to make sure that if your house is on fire, that your insurance is going to cover 100% of the loss, or at least as much as possible, versus just having a little bit of coverage because of just the nature of the way that it's set up. So once again, veer towards more long-term bonds versus short-term bonds. The other factor is that what most people don't realize is if you're going to get, say, anywhere from, say, 1 to 1.5% yield here, you can have anywhere from, say, 3 to 4% here. So just by the very nature of owning that long-term bond, you're also going to receive a higher coupon, which means your returns are going to be greater, you're going to have better protection, and it's going to allow you to protect more assets. The third thing is that because you have a heightened sensitivity, you don't have to own as much of that asset to protect your equities. Whereas if you own short-term bonds, you're going to have to own well over 50% of your portfolio, sometimes up to 70%, just to protect the most extreme volatility that the market's going to provide. Whereas if you own long-term bonds and long-term treasuries, you have to own a lot less of that asset to get the same protection. Because in the end, your market returns are going to come from your alternative assets and your equity-based securities over time, less from the bonds. So you want to be able to own less insurance than you would otherwise. And that'd be no different than any other thing that you would insure from an asset basis. So once again, if you have any questions about this, please leave comments below and ask questions. We're happy to answer, but hopefully this paints a little bit better picture of why you should always consider owning long-term treasuries and long-term government bonds and never any short-term bonds.